Hello, ladies and gentlemen. Welcome to Corp Insight, your source for business, finance, economy, and market analysis. We break down complex developments into simple, easy to understand insights that help you stay informed and ahead. Let's dive into today's story. In the world of financial markets, movement is never random. Every rise, every fall, every sharp correction is a reflection for something deeper happening beneath the surface. And today, the markets are sending a clear signal. Indian equity markets have slipped nearly 1%, hitting their lowest levels in over 2 months. What appears on the surface as just another red trading day is, in reality, the outcome of mounting global uncertainty. The benchmark indices, Sensex and Nifty both witnessed sharp declines. The Sensex fell by around 750 points, slipping below the 79,000 mark. The Nifty, on the other hand, dropped closer to 23,200 level. This wasn't a sudden shock. It was a gradual build-up of pressure driven largely by global cues that have been weakening over the past several sessions. To understand today's fall, we need to zoom out across global markets. Uncertainty has been rising. Investors are grappling with difficult questions. When will interest rates actually come down? The US Federal Reserve, which plays a central role in global liquidity, has signaled that rate cuts may not come as quickly as markets once expected. And when interest rates stay higher for longer, money tends to move away from equities, especially in emerging markets like India. This pressure is not limited to index level movement, it is visible across sectors. Information technology stocks were among the biggest losers. These companies depend heavily on global spending, especially from the US and Europe. When those economies slow down, IT budgets shrink, and Indian tech companies feel the impact almost immediately. Metals also came under pressure, reflecting weaker global demand signals, particularly from China, one of the largest consumer of industrial metals. Financial services and auto stocks also saw selling pressure, showing that the weakness is not isolated, it is broad-based. In contrast, defensive sectors like FMCG remained relatively stable, but stability in a few pockets was not enough to offset the larger wave of selling across the market. Another key layer in today's movement is investor positioning. Foreign institutional investors have shown caution in recent sessions. When FIIs reduce exposure, it often creates ripple effects across the market, as their capital flows are significant in scale. Domestic investors continue to participate, but their buying support has not been strong enough to fully counterbalance global outflows. At the center of all of this lies a broader global narrative. Inflation is not fully under control. Oil prices remain volatile, geopolitical tensions continue to influence risk sentiment. In such an environment, investors tend to shift away from risk assets and move towards safer instruments like bonds and gold. This shift in sentiment is what markets often refer to as a risk off phase. But history tells us something important. Market corrections are not unusual. In fact, they are a natural part of every financial cycle. Markets rarely move and in a straight line. Periods of growth are often followed by phases of consolidation. The key question now is not just what has happened, but what comes next. The next major triggers will be US inflation data, Federal Reserve commentary, crude oil trends, and foreign fund flows. On the domestic side, upcoming corporate earnings will play a crucial role in shaping sentiment. Stronger earnings could help stabilize markets even in a challenging global environment. For now, the message from the market is clear. This is not a collapse, it is recalibration. a response to global uncertainty, shifting liquidity, and cautious investor sentiment. And as always in the financial world, understanding the why behind the movement matters more than reacting to the movement itself. Thank you for watching Cop Insight. If you found this analysis useful, don't forget to like, share, and subscribe. Let us know your thoughts in the comments and stay tuned for more business, finance, and economic insights.